Hi, everyone. It's Peter Schiff. It is Friday, July 5th, 2013. Well, once again, the markets, the economists are looking at the economic glass as being half full with respect to the data that's coming out. Today, we got the non-farm payrolls number for the month of June. Once again, everybody is celebrating the headline number, and they are not looking beneath the surface. The devil, they say, lies in the details, and that is once again the case when it comes to the June employment report. The supposed good news, we created 195,000 jobs in June. That was better than analysts had estimated. In addition, there were upward revisions to the prior 2 months to the tune of another 70,000 jobs, so more jobs, good economic news. But if you actually look beneath the surface, and of course, you don't have to look too deeply to see these numbers, you'll find that the reason we have more jobs is because we now have a lot more people working part-time. The fact of the matter is we have fewer people working in full-time jobs in June than we had in May. The number of full-time jobs actually went down. We created more than 300,000 new part-time jobs in June, and that is masking the decline in full-time employment that is taking place beneath the surface. In fact, if you look at the jobs that were created, the biggest category is hotel and leisure. Included there is people that work at restaurants and in bars. You know, employment in bars and restaurants is now at an all-time record high in the United States. Is that because Americans are so much more affluent than we were in 2007, let's say, that we're now eating in restaurants and going to bars more often? I don't think so. I think what's happening is that bars and restaurants are laying off a lot of their full-time workers, and now they have to make up the slack by hiring more part-time workers. They reduce hours of their current workforce. Now they're part-time. They want to work full-time. And now they have to hire more part-time employees. In fact, this is borne out in the household survey. It shows that part-time jobs surged to a record by 360,000. Meantime, full-time jobs plunged by 240,000 workers. You know, you can't build a full-time economy on part-time jobs. You can't pay a full-time mortgage on a part-time salary. You know, a lot of these guys now that are working in bars and restaurants, they've got college degrees. A lot of their part-time income is going to repay their student loans. So this is not good news. And again, looking at the jobs that we created, I got a breakdown. In addition to the jobs that were created in leisure and hospitality, business and professional services up 53,000. Retail up 37,000, financial services up 17,000, and construction up 7,000. Again, leisure and hospitality leading the way, up 75,000. These are service sector jobs. They are part-time jobs. Some of them may be temporary jobs. We actually lost 6,000 more manufacturing jobs. In fact, this is the fourth consecutive month where manufacturing jobs have been lost. So I think, again, beneath the surface, this is bad news. In fact, the U6 unemployment rate, which is the number that includes people who are working part-time but who really want to be working full-time, that rate jumped up from 13.8 to 14.3%. That's a big jump in that rate. The official unemployment rate held steady at 7.6%. But again, included in that 7.6% are all these people who are working part-time who used to be working full-time, but now the best they can do is a part-time job because that's all this economy is capable of creating. Yet Wall Street, I'm sure the Obama administration is going to celebrate the fact that these jobs were created without paying any attention to the nature of the jobs themselves, the type of income that they're throwing off, and whether or not they are sustainable. Because you know what's also happening as a result of this supposed good news is interest rates are rising. The yield on the Treasury a 10-year rose above 2.7%. That's about a 2-year high. Mortgage rates will be rising now above 4.6%, heading up to 5%. That is now going to act as a headwind, rising interest rates, and it won't just be for mortgages, for car loans, boat loans, RV loans, big ticket items that Americans need to borrow money to be able to buy. All that's going to get more expensive. Again, the Fed is basing its recovery fantasy on the resurgent housing market. Well, the rug is being pulled out from under the housing market with rising interest rates, rising mortgage rates, and I think the speculators that have been the driving force in the recent rally, the hedge funds, the private equity guys, they're not going to buy anymore. I don't see how they can do that given the bloodbath in the bond market. I think they're likely to be sellers. So I think you're going to see a glut of properties on the market over the summer. So housing prices are going to go down. That means you've got a reverse wealth effect. Meanwhile, look at the price of oil today. Oil prices continue to rise, as I've been warning, now above $103 a barrel. So yeah, you've got people with part-time jobs. They got to pay more for oil. They got higher interest rates. We know taxes have gone up. Healthcare costs are going up. Sure, President Obama just announced that, we've got a year delay now in the employer mandate. One of the reasons that we've got all these part-time jobs is because employers are trying to get out from under that mandate by reducing the hours worked. Now, will this somehow lead to employers to postpone those layoffs for another year? I don't know, but maybe that will actually work negatively in the short run, because if companies don't have to hire the extra part-time workers and reduce their hours, then a lot of these part-time job creations won't be taking place. So that could actually have a perverse effect on the numbers when you realize that the only reason we're getting jobs is because we're replacing full-time jobs with part-time jobs. But again, these are not the kind of jobs that are going to make the economy stronger. In fact, if you look at the trade deficit that came out earlier in the week, the trade deficit, I think this was, the trade deficit was May's number, but it surged by 12% to $45 billion. And in that report, imports were the second highest ever. Exports actually declined, so the trade deficit swelled. Losing more manufacturing jobs, getting more of these service sector jobs is going to create a bigger trade deficit. Look, when the bartender cashes his check and he wants to buy stuff, he's going to buy more imports, because you can't buy what a bartender is serving. If you live in Asia or Europe, you got to come all the way to America to have a drink in our bar. I mean, maybe the tourist trade, but these are non-exportable. We need to export stuff. And in fact, we got the ISM Purchasing Managers Index survey that came out earlier in the week that, again, Wall Street reacted to the headline number, which was up after the prior month's contraction. But what stood out to me was the fact that manufacturing employment in that survey actually dropped for the first time in 4 years, since 2009. So we're getting a lot of bad economic news. In fact, was it the prior week, we got the final revision to first quarter GDP. And the government initially had estimated that the GDP was, 2.4%. And now they revised it all the way down to just 1.8%. So again, the economy grew a lot less than the government thought. I think future GDP numbers are also going to be diminished by these larger trade deficits, which of course subtract from GDP. But again, if a lot of people are working part-time instead of full-time, they've got less real income to spend. And if they're spending more of those incomes on higher oil prices, higher taxes, higher medical bills, higher interest, especially if you have an adjustable rate mortgage and those things start to reset. And remember, a lot of Americans have been relying on refinances to continue their consumption bins. No more refis. That's it. Rates are at a 2-year high. So if you've already refinanced in the last couple of years, you obviously can't do it again. And so that well is run dry. And so I think as the months progress, then you're going to see people starting to wake up to this grim reality, including the people at the Fed. They're going to have to fess up, I think, and actually talk about expanding QE, not contracting it. Meantime, The appearance of good news, U.S. stock market rose, the dollar rose, gold fell again today. Gold stocks are down. Part of the reason that the dollar is rising, you do have some turmoil abroad. You had some very dollar-friendly statements coming out of the ECB on the holiday, where you have the ECB talking down the euro by saying that these low interest rates are going to be here for a long time. But, what does that mean for the Europeans? Oil prices are at $103 a barrel, even though the dollar is relatively strong against other currencies. That means oil prices are rising even faster for everybody else. So a lot of these countries around the world that have been deliberately talking down their currencies, trying to move their currencies lower, they're going to have to feel the sting of even higher inflation, because now they're seeing these commodity prices going up, particularly for oil. Eventually, they're going to have to stop all this talk and actually start tightening, start raising interest rates, because they won't be able to deny the effects of inflation. And you already have, especially in the emerging markets, people are already protesting the rising cost of living, which is now rising even faster because those emerging market governments are proactively trying to weaken their currency for the specific purpose of propping up the dollar. Now, of course, we need a strong dollar, because if the only jobs we're creating are waiters and bartenders, and they need to spend those dollars they earn buying imports, well, we need a strong dollar so the waitresses can still go to Walmart and buy stuff. We're not worried about the competitiveness of our exports, because our exports keep shrinking. What we need to do is pay for our imports. And the fact that the dollar is artificially high makes it a lot easier for us to do that. We also have to convince the world to loan us money, and the only way we can do that is to get them to believe that they're going to be repaid in a stronger dollar. After all, the Treasury prices are falling in terms of dollars, but they're not necessarily falling right now in terms of other currencies because of the relative strength of the dollar versus those currencies. But certainly for a U.S. investor, there's no reason to hold bonds. That's why bond prices continue to fall, again, hitting new, I think about 2-year lows today in the 10-year and the 30-year. And this has got to be very troubling for Ben Bernanke. This was not his goal when he decided to discuss the possibility of tapering. And of course, I don't believe he has any intention of tapering. He just wants to discuss it, because he can't actually do it. But he can't admit that he can't do it, because that would be a disaster. So all he can do is talk about something that he knows he's never going to do, yet he's going to have to find an excuse to do it without admitting that he never intended to do it in the first place, and that he's doing it because the economy can't survive without his help. So he's probably going to try to rationalize another excuse. Maybe he'll say that inflation is too low, but that's not it. What he really fears are rising interest rates, rising mortgage rates, and how that will derail the phony recovery that he has created by blowing more air back into the housing bubble, and the wealth effect and the confidence and the borrowing and spending that has gone along with it. He's going to have to do whatever he can to maintain that illusion. And so I think the markets right now are trading on a false narrative. They're trading on the fact that the U.S. economy is recovering, that inflation is not a problem, and that the Fed's going to tighten. All of this is wrong. The economy is not recovering. It's relapsing back into recession. Inflation is a problem that's getting worse, and the Fed's not getting ready to tighten. It's getting ready to ease. That's it for now. Everybody else, enjoy the rest of your 4th of July weekend. Remember to continue to listen to my daily coverage of what's going on in the markets and around the world on my radio show at schiffradio.com. Bye for now.